a record-breaking IPO, the worst market day in months, and a new Fed chair nobody can read. 3 headlines, all of them demanding that you do something. Today, we'll unpack why they share one answer for retirees and why a simple bucket structure and a well-timed tax move matter more than any of them.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
And hello, Leibel Sternbach. How are you, sir, from Yields for You?
I'm doing good. How are you today?
Unbelievable. Boy, we got the headlines today. Let's jump right into it. First, the hot IPO. Everybody's talking about the SpaceX IPO label. Should I put some of my retirement savings into it before it takes off, or just wait for it to blow up on the launch pad?
On the launch. See that really lies the question of IPOs, right? Is will it blow up on the launch pad, or does it become a rocket ship and make its way to Mars, right? And honestly, like, we have no idea which one it's gonna be. And there's a lot of money on both sides of that equation. Elon Musk is notorious for attracting short sellers and hating short sellers. But Elon Musk is also the richest man on the planet for a reason, because somewhere in the last 20 years, he figured out how to work every lever of every system in his favor. And this IPO is, wow, people are going to study this for generations of either the biggest success or the biggest flop in history, but he has pulled out every stop. Like, this is going to make the textbooks. So to answer your question, right? You asked the question, should I own this in my retirement accounts? Yes. I think that really depends on, your retirement account, right? It depends on what your appetite is for this type of growth, what your ability to absorb the losses are. And I think the question is how much is okay to put into something like this if you're inclined to put it in. And this really is really bringing to light both the benefits and the dangers of index investing. And it's bringing to a head how active or how passive is index investing, and should you be more active or more passive?
Interesting. We're talking with Leibel Sternbach, and I'm wondering, so what would we actually be buying, Leibel? Equity in the company, or a lottery ticket, or a initiative, or what?
Yeah, well, so the IPO, the stock actually lists on June 12th. So it's, at that point, you'll be able to buy that stock. You'll be able to buy that stock. Most of the stocks are already going to have been purchased by people. They're already pre-sold before it lists on the exchange. And so that is something to be aware of, right? Initially, it was only institutional investors who would have access to it, or people who already invested, like the venture capital companies that already invested in SpaceX and their employees. But a number of these shares have been opened up to the general public through, Elon Musk engaged 23 investment banks to help market the stock. So you can access it through, Schwab and Fidelity and even Robinhood. All of these companies will allow you to purchase these pre-initial public offering stocks, if you wanted to, at the price set by Elon Musk.
Interesting. So if SpaceX does what the hype says, and there's a lot of hype, and I happen to miss it, is there an actual damage to my retirement plan, or am I okay?
So I don't think there's damage. It's more about missing out on an opportunity, and that shouldn't be a reason why you do something. When it comes to are you missing out on something, and this is really where index investing really shines. The purpose of index investing is to help to try to have to pick stocks. And so instead of picking stocks, what you're going to do is you're going to buy an index of stocks, a basket of stocks, and then is, you get new winners and you get new losers. You're going to drop the losers and you're going to buy new winners. And that's just going to happen for you automatically, generally on a quarterly basis. So when we look at, are you going to miss out? Well, if you're invested in a broad index, right, like the S&P 500 or the NASDAQ, you're going to automatically purchase SpaceX stock if it is a winner. If it is a loser, that's where the question becomes in, right? If it's a loser, you may never purchase it because it never made it to be the top 100 or the top 500 companies of the index. Having said all of that, right, like in your retirement account, this is one of the things that Elon Musk has done that's like just truly incredible, is he went and shopped around at the New York Stock Exchange and the S&P 500 and the NASDAQ, and part of his pitch was, I want to have the biggest IPO in history, and what are you going to do to help me make that happen? And the NASDAQ said, we're going to change the rules of who gets included in the NASDAQ. And in the NASDAQ index, so the top 100 companies on the NASDAQ exchange, we're going to change those rules. Usually you have to wait a year before you can get listed. We're going to waive that for a company of your size, and you're going to be able to get listed after 15 days, which is just truly incredible.
It is incredible. So since Elon is forecasted to be the world's first trillionaire, is it impossible for me to put too much into of my savings into any single stock, including SpaceX?
That's, again, right, like what defined too much, right? Like, is the arguments for and against that have been raging for the last 40 years. And if you had said, right, I don't want to concentrate more than 5% in any given company in the S&P 500 because that's too much risk, well, you would have missed out on most of the gains for the last 20 years. Because most of the gains have been concentrated in a handful of companies. So when you say how much is too much to have in any single company, I don't know that the academic answer is the correct answer, because at the end of the day, right, you do need to get market-like performance. You do need to get these returns. Now, depending on where you are on your risk-reward spectrum, depending on where you are on your retirement journey, right, depending on what money you are investing will determine kind of how much risk you want to take. But ultimately this comes down to human nature, right? And if the name of the game has changed, where not all stocks are benefiting from growth the same way, then you can't afford to just diversify equally across all the stocks, because all you're doing is diluting your returns.
You mentioned earlier about getting in early, but what if I missed that buying time and the big run up? Am I better off staying on the sidelines and being patient, or go ahead and jump in late?
Well, I'm gonna share with you what the late Charlie Munger, said, and this was the lesson he taught Warren Buffett. Right, Warren Buffett would look for companies that had great value, right, and he was making good results, right. I mean, Berkshire Hathaway was up 40,000%, but it really took off like a rocket ship when Charlie Munger came along and taught Warren Buffett that not only to buy great companies, but to buy them at a great price. And so, should you get in at any price? I don't know, right? Like, what is too high of a valuation? What's too low of a valuation? There is, only history will tell the answers to that, which is, again, why you got to go back to your risk reward when it comes to this type of. When it comes to a stock of this value, this has never been seen before. We've never had a company or a person who was so aspirational that nothing that they were doing made any sense, right? Like, there's no real economics behind it. There was no economics behind Tesla. Tesla was making more money selling energy credits for the longest time and nearly went bankrupt several times. But guess what? It turned that he was able to turn that company around. He was able to make it into a true car company, right? He was able to use that to fund, his purchase of Twitter, to fund the starting of XAI, to fund SpaceX, which is now the most economical, low orbital delivery system on the planet, right? He is reviving our space industry like almost single-handedly. None of this follows any logical reasons, right? He's doing things that governments, struggle to do, and he's doing it as a private citizen.
We're going to keep a close eye on that because that is really interesting as history in the making. Let's move over to the market drop. You ready?
Yep.
So if the market just dropped 4%, I just picked that number out of the air. If the market dropped 4% in a day, Leibel, is my retirement money safe, or do I need to do something right now? Do I need to be giving you a call?
That 4%, right? The NASDAQ dropped almost 5% this past Friday, which is insane, right? It's an insane single day drop. And 10 years ago, you would have said it's once in a decade, right? But it happened last year. And it's the question is when you look at these things, and before I even get to that, right, when you look at it and you go 5% drop, that's insane. At the same token, today it's mostly recovered, right? It's on its way back up. So the question really becomes, right, is this the new normal, or is this a indicator that there's something fundamentally wrong with the economy, with the stock market, with whatnot? And we can explore each of these questions, but I want to reframe it for you, right? Because whether or not the market is broken, whatever is happening, the fact is that when we are retired, unless you want to go back to working and you want to go back to getting a W-2 job, which arguably that's even more broken of a system than the stock market, you are going to have to figure out some way to participate in this, because it's the single greatest wealth creation engine, and it is kind of the only way to outgrow inflation, right? To have your money grow faster than inflation. So you got to ask, the question really isn't, is this an okay place to be? The question you got to ask yourself is, how can I make this a safe place for me to exist? How much of my money is okay riding this freaking roller coaster so that I can have a financial future? Because if you don't put your money in the market and you're like, hey, I'm going to give it to an insurance company, I'm going to buy an annuity, I'm going to, enjoy the benefits of having a guaranteed contract. Well, guess what? Your money is not really going to go anywhere very fast. And you're going to be looking back at 20 years or 30 years, and you're going to be like, why can't I afford any of my expenses? Why can't I not buy groceries? Why can't I pay, my property taxes? Why can't I give my grandkids gifts? I used to be able to go on Christmas and give them stuff, and now I can barely afford to buy them candy because my money just doesn't go anywhere.
A friend of mine says that it's bad when your money is funny and your change is strange. So how do you avoid being forced to sell your investments at the worst possible time, Leibel?
So that fundamentally is the question. That is one of the biggest and hardest questions to answer. The way that we approach it at Yields for You, right? We like to do it in a way that we call time diversification. And what we do is we take your money, separate it into 3 different buckets, right? And I'm sure you've heard a million times people talk about emergency funds. Well, your first bucket is kind of an emergency fund, except we're retired. We're living off of this money, right? We don't have a salary, which means it's an active fund. It's not an emergency fund. This is our lifestyle fund, right? This is what's paying the bills. This is what's supplementing Social Security. So your first bucket of money, just like you would have with an emergency fund, where you have it in low risk, right? Something that when you pull the money out, it's not going to decrease in value. That is number one. Or you want to have 2 to 3 years in that bucket, right? That's why we launched our ETF YFYA, because it's kind of like, it pays more than a high yield savings account, but if the market goes down 50%, you're not risking that it's going to go down more than 5 or 6%, right? You're not risking a catastrophic loss, which is what is so fundamentally important for that first bucket. That then shields you for a second bucket. Your second bucket is you're going to get some growth in there. You're not going to get the full market growth, right? Because the market can go down 5% in a single day, right? It can go down 50%. It can go down 80%, right? Like, these are things that can happen in the market. Mm-hmm. And if the market is down 50% and you have to pull money out to live off of, right? Well, then you're going to compound your losses, and that's how you run out of money in retirement. So what we're going to do is more like that 60-40, We're going to use instruments that are similar to what the insurance companies use. If you want to buy an annuity like a MYGA or whatever in that bucket, that kind of works. Long-term CDs that are tied to the market, these market-linked CDs, that's a good thing to have in there. Principal protected notes. Things that have greater growth than high yield savings, but still give you a lot of downside protection. That's what we have in that second bucket, which then now you've built a shield, right? So now if the market's down 5, 6 years, 7 years, right, you've got protection, right? You've got the ability to weather almost anything that the market can throw your way, which then allows you to take the remaining bucket of money and invest that according to what you can tolerate. Whether that's fully putting it in the market, whether that's concentrating super into IPOs and doing what you want to do, right? That's up to you. But we put it into a growth bucket, and that's how you have that stability during retirement, so that when the market goes down 5%, you see that as a buying opportunity. You see that as a taxless harvesting opportunity. You see that as a Roth conversion opportunity, rather than seeing that as, am I going to run out of money in retirement?
Everyone, we're talking with Leibel Sternbach. So is it virtually impossible for you to run out of money before you die?
As the SEC is very, loves to say, right, there are no guarantees in life, right? Past performance is not a guarantee of future results. Who knows? It is not. In fact, it's almost the biggest indicator that the future will not be like the past, right? If you believe that the next 20 years are going to look like the past 20 years, then I got a bridge to sell you, right? It is. That is not the way you want to be running your life, is operating based on the past. You want to be informed by it, but you don't want to be married to it, right? Because if you are married to doing what worked in the past, then the world is going to slip you by. And there's countless examples of people who held firm and were like, no, this is how we do things. This is how the world works. This is how investments works. And then the world screwed them over. So what you really want to do, right, is you want to create a plan. You want to know what are the things that you're looking out for, so that when the world changes, you can see the signposts for that change coming, rather than being like, we missed the turnoff 30 minutes ago and we're about to run out of gas, right? Like, you really don't want that happening.
No, we don't want to run out of gas. Thanks for that primer on that. Let's move over to the new Fed chair. I noticed that Jerome Powell on his way out was honored by the Kennedy Center Honors Brave Courage Award. And I keep hearing that the new Fed chair, Leibel, wants to lower rates. Should we wait for the rates to drop before we make any big money moves at this point, or do we continue as we have been when Jerome was in the chair?
That's a hard question. That's a very hard question. It's one that keeps me up at night. So as the portfolio manager for the ETF YFYA, which is the Yields for You Income Strategy A fund, this is the question that I have to constantly answer: is where are interest rates going to be? Is the Fed going to lower or raise them? And the reason why it's so important to kind of know this answer ahead of time is because the second that the market believes with a fair amount of certainty that something is going to happen, then the market moves as if it's going to happen, right? And so the interest rates will effectively go down, or they'll effectively go up. And if you're on the wrong side of that transaction, you either lose money or you make a whole lot of money, right? And so the real question is, and this is the question that I ask myself, and it's what every investor who's living on a fixed income needs to ask themselves, is how can I take the least amount of risk possible to get the greatest return, especially on my safe money, on my low risk money, on the money that I can't afford to lose too much on, which is what the YFYA was built for. And so when we look at that first bucket and we're looking at interest rates, Jerome Powell was very clear that he wasn't certain that lowering interest rates was the right thing to do. There were various Fed governors for the last year and a half, on both sides of that argument, saying about lowering interest rates. But the problem is, and this is, the Fed's got two mandates. They got to make sure that we have healthy employment, and they got to make sure that we've got healthy employment and we've got healthy money flows. And those are difficult things to that the economy is growing at the right pace and that we've got a healthy economy and a healthy employment. And those are right now very weird things, because for the last year and a half, we've had employment was shrinking, but the economy was growing. And now we have, for the last 3 months straight, it could still be revised, we've had stellar growth. So we've had growing employment and growing GDP. However, inflation has been on the rise, right? And so inflation has really been on the rise, very much due to what's happening in Iran and the Middle East with the Strait of Hormuz. However, there's a lot of other factors in play, right? And so the Fed is balancing this question of, do we raise interest rates to reduce the money supply, to reduce inflation, to help make sure that the economy can keep growing? And so Kevin Warsh, his stance before taking office was that he wanted to reduce interest rates. That's why Trump went and put him into power, right? Who, pushed for him to be in there. We had a number of Fed governors who wanted to reduce interest rates. In the last 2 Fed meetings, we've had a number who said that it's time to talk about raising interest rates. So I would not bet on interest rates going down until we see them going down. And it is a very weird place to be in, because if you bet that interest rates are going to go down, that means you have to take more risk in your portfolio, because you have to chase things that are going to give a greater return. Right. And if the economy, if the rug gets pulled out from under the economy, either because of the Strait of Hormuz and all the damage to the oil infrastructure that happened in the Middle East, or because we have this AI bubble and it collapses, or because we have interest rates rise and all of a sudden all the free money or the relatively low interest money that is being used to prop up the economy disappears, what happens? Right? What happens to your retirement savings? So the stock market right now, a lot of the growth it's tied to 2 things. It's tied to AI, and it's tied to the fact that interest rates were going to come down. Part of the reason why the market went down so much, 5%, the Nasdaq went down 5% in a single day, was we got a good job reading that day, and there was trouble in paradise when it came to AI, like a double whammy. So when you ask the question, should we act as if interest rates are coming down? I wouldn't count, what's the expression? I wouldn't count my chickens until they hatch, right? So I wouldn't hold my breath on that one. I think that we've got an equal probability of increasing interest rates as well as lowering them. I'm still betting that long term there's going to be growth. And so I would like to be more aligned on the interest rate spectrum with companies that are on the growth side of things. So a little bit more riskier than lower risk, because when you look at the credit spread, right? Like not the credit spread, but when you look at the credit quality of companies are using money responsibly. They're not over leveraging themselves like they were in 2008 or 2000, really the dot-com bust. We're seeing people be responsible. So I'd rather go for like a middle company that can't get best interest rates, right? They're not a Microsoft, but they'll get, they have to pay 6-7% interest rate right now to get a loan. I'd rather get that 6-7% than putting it in the stock market necessarily, where I can lose the 50%. At least on a bond, like I'm not going to lose 50%. I still get my principal for the most part.
So is that the answer when the Fed chair can't even tell you which way the rates are going to go? And we're talking to yieldsforyou.com and other advisors out there. What are we supposed to do? I mean, I saw a sale label on crystal balls. I was concerned about purchasing that too.
This is a reminder, right? It is a very much a reminder that the market is driven by people and not by facts, right? Everyone has got their crystal ball and they're trying to peer into the future to see what is happening. But fundamentally, right, the market is moved by buyers and sellers. It's not moved by fundamentals. It doesn't matter how much revenue SpaceX is making. It doesn't matter that it's pricing as if it's going to make the 100 times earnings, right? Like that's insane amount for a company. I think like Google's 12x or something. And SpaceX is 94x, right? Like these are insane numbers for companies, but at the same time, the price is moving, right? There are more buyers than there are sellers, and that's making the stocks go up. And that's human nature. That has nothing to do with fundamentals. And so we're just bringing this back to SpaceX and the IPOs. We've got Anthropic and we've got OpenAI who are on deck for IPOs. We've got a few other companies that are coming for IPOs. These companies are not trading based on fundamentals. We don't have institutional investors who are like, you got to prove that your business model works. You got to prove that you can bring in the revenue. You got to prove to us that this, $1 trillion company can actually produce $1 trillion in revenue. All these people have to prove right now is that their aspirations are life-changing for humanity, and that they have some shot as making it happen, right? Elon Musk, he made as part of his package with this whole IPO, he made part of his package that he's going to get 1 million people on Mars. Do we think that's even realistically possible? Like, if you just sat for a second and really thought about it, right? Like, the amount of money it would take, right, to build an infrastructure to support 1 million people on a lifeless planet that can't even produce oxygen, right? And to get them over there, right? Like, even right now, if we want to travel to Mars, is only once every 3 years that it's aligned so that we can have a short trip. And a short trip for that, I think, is like 6 months or 9 months, right? That's an insanely long time. Like, just to keep someone healthy for that long in space is almost impossible. But we're betting on it. We're betting, right? Not the world, but enough people in the market are betting that Elon Musk can make that happen. And even if he doesn't make that happen, that he's going to get something so close that it's going to be a moot point, right? And is he capable of doing that? Probably. Who knows? I think he's definitely capable of inspiring enough people to make that happen. And that's really, at the end of the day, the question we got to ask ourselves is not, is he capable of making $1 trillion or whatever the next number after that is, but is he capable of inspiring enough buyers to buy his stock to make it worth more money? And I think the answer to that question is yes. So,
as you said, the market is more dependent upon the people, the players, than any stat that you can find. And it makes me think about, we've talked earlier about the 3-bucket approach. Joined us, and maybe they've not heard you talk about the 3 buckets. We hear about it often. How is it different than just having money in the market? And how do those buckets interrelate, Leibel?
Yeah. So if we just have all of our money in the market, then we're subject to all these market conditions. And so what'll happen, right? You have your buyers and your sellers. And as often happens, right, we as human beings like to move as a herd, right? We're herd animals. We're very social. We like to do what other people are doing. We don't like feeling left out. And these are survival instincts. And so when it comes to the market, we're no different, right? Something will happen that will freak everyone out, and everyone's going to just start pulling their money out of the market because they're worried that the sky is falling. When the sky starts falling, right, it doesn't move. It doesn't go slowly. People don't exit the theater in an orderly line, right? They always stampede, and there's always people who die in the stampede, right? It's always how it works. Same thing happens in the market, right? What the buckets allow us to do, right? So if we just have our money invested in the market, then essentially we're no different. We're just going to get caught up in the crowd, and maybe we get stampeded to death, maybe we don't. If instead we bucketed our money, right, and we said, okay, the money that we're going to be living on for the next few years, we're going to put at very low risk, right? That's going to be sitting by the exit, right? We're going to be that person who knows where the exits are and sits by the emergency exit all the time, right? But that's not a way to live, right? But you know what? The person who's doing that, they're never going to be the one who's stampeded to death. So we don't take all our money. We just take a little bit of our money that we need for the next few years. And then we take another bucket of money and we say, you know what, this money, we're going to be a little more aggressive, but we're not going to sit like in the absolute middle of the theater in the best possible seat, right? Where you get to see everything, because that's like the hardest, if there's a fire, it's the hardest place to get out of, right? You're right in the middle of everything, but it's the best seat, all right? So we're not going to sit there. but we'll put a little bit of our money closer to the door, right? And then we'll put the rest of our money like, okay, listen, if those kids, don't make it, that's all right. We've got our other kids, right? And we divvy up our buckets of money that way. And that allows us to spread our risk out so that if there is a stampede, at least we know the kids that we really care about are going to make it out of the theater, and maybe the other ones, right? And if we lose some of the other, the long-term growth ones, we can live with it, right?
Where do you come up with these scenarios? My gosh. The kids you care about, the ones you don't care about so much.
We all know we got favorites.
So what's the difference, Leibel? You got me on this one. What's the difference between chasing a stock and actually having an income plan that you can count on every month?
So the difference between having a plan and chasing the next best thing is that if you're constantly chasing the next best thing, then you're going to get caught up in all the hype and you're gonna get stampeded, right? There's no two ways about it, right? Like the expression goes, right? Everything that comes up must come down. And really the only way that you win in the stock market over the long run is by playing the odds, right? Like you could, in theory, every time pick winners, but like, would you bet on somebody who is gonna go and only pick winners, right? If you went to a professional stock trader, they're not going to say, I plan on winning 90% of the time, right? Like that's somebody tells you that I win 90% of the time, they're a liar, right? Or they just haven't traded often enough to lose, right? Either way, not someone who you should give your money to. What you want is somebody who says, I have a way of stacking the odds in my favor. My plan is to win 55% of the time, 65% of the time. And I have a plan so that when I lose less than a catastrophic amount. Because if you lose everything all in one hand, then the game is over. So you need to make sure that your losses, because you're going to have losses, make sure that your losses are not catastrophic and make sure that your wins are enough to make back to put you ahead. And that is the difference between a hope and a prayer and, constantly chasing the next shiny object. Is if you're constantly chasing the next shiny object, then you are at risk of picking the wrong one because you never know who's going to be the next Enron, right? You never know.
Exactly. So how does having this kind of a strategy, I'll call it, change the way that we think about market volatility?
If we didn't have a strategy, then we're afraid of volatility because volatility becomes, negative confirmation that we chose the wrong thing. And it tells us, oh no, this thing that I thought was going to be a winner is actually a loser. But if we plan for volatility, if we have a plan and we know that we're going to have winners and losers, then volatility becomes a feature and it becomes something, either an opportunity for us to buy more of something that we're confident about. It allows us to do tax loss harvesting. It allows us to do Roth conversions. It allows us to buy more shares at a cheaper price, right? Which is what Warren Buffett is famous for doing, because this is a feature that we know is going to happen on a regular basis, right? We know a 5% correction is going to happen every 3.5 months. We know a 10% correction is going to happen every 18 months. A 20% correction is going to happen every 3.5 years. If we know that's going to happen on a regular basis, then we could just time. We could just wait for that opportunity, right? And it's okay, well, I got cash sitting on the sidelines. Well, should I get in now or should I get in 6 months from now? Well, if I'm trying to think about like whether Tesla or SpaceX is going to go to $1,000 a share, that's something I can't know, right? It's impossible to know the answer to that question. But if you tell me, hey, is the market going to go down by 5%? 100%. There's 100% chance that's going to happen. And you know what? I'm going to wait for that to happen and then I'm going to invest your money. So, yeah.
That makes a lot of sense. So in thinking about that, you mentioned a Roth in that discussion. People say that a down market is actually a great time for a Roth conversion. Why would you pay taxes? Why would I want to pay taxes when my account is down?
So when it comes to Roth conversions, right, everyone thinks about, well, I want to pay taxes on the seed and not on the harvest, or I'm going to have these RMDs, I'm going to pay this huge tax bill. Well, I want you to think about the question differently. want you to think about it. This taxes is going to get paid regardless. The question is how much of this taxes is going to get paid and when is it going to get paid? And so just like we know that the market is going to go down on a regular basis, what if I can tell you that the IRS was going to have a sale every 3 months, right? Would you pay your taxes just randomly or would you pay it when it goes on sale?
You'd be on that schedule.
Yeah, you would pay when it goes on sale. If you get a discount, you wait for the discount, right? Black Friday comes along and that's the great time to buy Christmas gifts, right? You wait for Black Friday. You don't just go buy it on after Halloween, right? It's not the time. So the same thing happens with Roth conversions and tax loss harvesting. So Roth conversions, you wait for the market to drop. We know it's going to drop. You got to do a little bit of prep work to make sure that you could take advantage of it, that you're invested in a way that will actually drop and that you know what to do and you have everything in place to act on it. So when the market goes down 5%, you move your money over and you got a 5% discount. And guess what? Most people are doing Roth conversions. They've got years. They've got years until they've got their RMD problem or the RMD problem is big enough that it's a serious problem. There's going to be a 20% correction. There's probably going to be a 50% correction. Why wouldn't you just wait for that rather than trying to let your anxiety drive you and just be converting willy-nilly because somebody told you to convert? Have a plan. Put the pieces in place, time when to do those conversions so that you pay the least amount of taxes possible and you come out ahead.
Interesting. So here we are, we're sitting at the middle of the year. Won't doing a Roth conversion like right now just raise your tax bill this year?
So you will definitely pay more taxes this year. And this is, again, why you got to plan for this. You can't just be like, oh, I'm doing Roth conversions, right? You need to know how much to do and when to do them so that it actually effectively lowers your taxes. Because guess what? If you're making the most amount of money right now than you've ever made in your entire life, then it's probably not the year to do Roth conversions, right? I have no idea. You have no idea how many people come to me and they're like, I'm 2 or 3 years away from retirement. And I want to do Roth conversions. I'm converted all of my contributions and my 401k to Roth. And I'm like, why are you doing this? You're retiring in 3 years. You're going to have no income in 3 years, but you want to pay it now when you're making, $300,000 a year. Did you make $300,000 a year 10 years ago? No. But now when you're at the peak earning and you feel like you're at the top of your game, now you want to give the IRS more? You want to go make donations to the government who doesn't really, know where they're spending the money? This doesn't make sense. So, you got to think about things. You gotta change the lens that you're looking at it through. And remember, it's the number one risk in retirement, right? You want to make sure that, whether it's you want to prevent that drawdown, whether it is from market losses, whether it's from overpaying on taxes or paying retail, right? You want to keep as much money in your pocket as possible because that pays for your healthcare, that pays for your grandkids, that gives it gives an estate for your spouse, it gives an estate for your beneficiaries or the charities. Right? Make sure that you got a plan in place. Otherwise, you're just donating to the IRS, right? And the IRS will thank you for it.
So how does that Roth conversion then interact with your Social Security, with your Medicare and your other income sources? You said you want to make sure you have money for X, Y, and Z. Tell us about that interaction.
You retire and you're like, I'm not going to have to pay any taxes, right? And then the IRS comes along and says, no, up to 85% of your Social Security is going to be taxable. You're like, this came from my payroll to begin with. Why am I paying taxes on it again? Fine, I'll pay some taxes on it. And then they're like, and your investments, and that money that you got, in the high yield savings, those bank CDs, that's going to be ordinary income. And then before you know it, then they're like, well, listen, you're making too much money. So instead of giving Medicare to you for free or for only $100 a month, we're going to have to charge you more because, it's not fair to the poor people. And you're like, but I'm a poor person. I did everything right. So you're going to give it to the people who spent all their money and took the wild vacations and I'm going to be left paying their bill? Yes, sorry, right? So you want to make sure, right? Like, people come to me and they're like, well, how should I be invested? I'm 60-40, I'm whatever. I should do Roth conversions, not do Roth conversions. I'm like, I need to see your tax return. Let's make sure to plug the sieve, right? If we have a leaky bucket and all the money is coming out the bottom, all the Roth conversions in the world aren't going to do you any good because you're going to be paying taxes at the highest tax bracket. I had a woman the other day come to me and she wanted Roth conversions. She's got like $1 million, $1.5 million in her retirement accounts. And she's like, I was told to do Roth conversions. I'm like, who told you to do that? Like, yeah, it's just something I heard. I'm like, oh, okay. Let's take a look at your situation, right? Let's take a look, fill out a form for me. She fills it out. She's got $40,000 in dividends coming in and $140,000 a year in taxable interest. Wow. This woman was paying like 32% tax, right? Single person, right? But her Social Security was only like $35,000. She was barely living on anything, but she was paying this an enormous amount of taxes because she was being safe. She had this money in a bank account earning interest, and she thought it was the right thing to do. But she was paying interest on it, right? It was a huge amount of money that was just sitting there, and basically she was not taking any risks, so she wasn't getting any rewards. And then whatever little reward she was giving, right? So she's not even keeping pace with inflation, and then she's giving half of that to the IRS. It's ridiculous.
That's bad. So is there a calculator or something like that to help avoid scenarios that you just painted at yieldsforyou.com?
So at yieldsforyou.com, we offer a free retirement tax SWOT analysis. Really, really recommend that you take us up on that. Go online, click book an appointment, go to our FAQ page, fill out the form. You'll upload a whole bunch of documents, fill out a whole bunch of questionnaires, but then we'll give you this analysis and we'll tell you, hey, by the way, right, like maybe Roth conversions aren't right for you. Or maybe you should be super aggressive about them and do it over the next 3 or 4 years. Or maybe really you only need to convert, $500,000, or maybe change how you're allocated. Maybe you've got all your growth stuff, right? And you have it in your IRA and it should be in your Roth, or it should be in your brokerage account. And just switching it around will solve your problem and help you pay a whole lot less in taxes. And so this is what we do, right?
Is there a break-even point? How long does it need to be there to grow tax-free in the Roth for it to be worth it?
And that's, again, right, how you're invested really, really makes a difference, right? If you're super conservative and you're like, I'm in a high-yield savings account or I am all in bonds, well, it's going to take you like 30 years to break even on doing your Roth conversion, right? Whereas if you're super aggressively invested in stocks, right? I had someone I spoke to today, and he's like, he's got $10 million in a IRA account, and he's like, I can't convert fast enough, and I'm primarily invested in tech. My money has doubled in the last 3 years, and I converted 3 million of it, and it's like, he can't convert fast enough because he's invested so aggressively, right? So his break-even point is like a fraction because as soon as he finishes paying off the taxes, he's made more money in growth than he paid in the taxes. So again, right, really depends on how you're invested, what the purpose is. For the average person, right, where you're like 6-7%, you're kind of middle of the road, right, conservative, maybe moderate, right, nothing too crazy. You're looking at 15 to 20 years break even, right? That's not simple math of like, yeah, you should for sure do this, right? You got to really factor it in to your financial plan.
Got to think it through. Let's talk about thinking it through. That involves the human element. So how do you explain to your wife, for example, or maybe to your husband, why we're staying so calm when the market is dropping, where everyone's losing their pants, when everybody else seems to be panicking? How is it possible for the calmness to be that house?
So I'll share with you a story, right, that happened in my own life, right? So when I was ringing the closing bell for the New York Stock Exchange, when we launched our ETFs, YFYA and RSMB, my wife asked me, like, why didn't you tell me about this, right? Like, you're launching an ETF, you're getting honored like this to be able to do this. This isn't something that happens overnight. Why wouldn't you tell me like that this was happening? And I said, because I know what comes next, right? This is, everyone's excited for this moment, right? But this is the beginning of the hard work. So I'm nervous for, I've just been doing all this hard work, and I'm nervous for all the hard work that is to come. And so the answer to that question of how can you be calm when the market is volatile and everyone's freaking out The answer is twofold. Number one is you did the job of worrying when everyone else was calm, right? When everyone else was calm, you realized this is the calm before the storm, and you put things in place so that when the sky falls, it doesn't hurt you, right? So that you are calm because you're like, I knew this was coming. I didn't know when, I didn't know how, but I knew it was coming and I was prepared, right? So that's number one. Number two is that you remind yourself while everyone is running for the exits, that Warren Buffett, that you should be greedy when others are fearful and fearful when others are greedy, right? And you remind yourself of that when everyone's rushing to the exits, right? Don't look at it as a confirmation that you did something wrong. Look at it as a buying opportunity or a tax saving opportunity and have the plan in place to do it so that you can profit. Because the people who had cash during 2008, the market went down 55%. They made enormous amounts of money. They bought companies for pennies on the dollar. They bought stocks for pennies on the dollar. And they made it back. Not only did they make it back, they made a huge amount of profit. And so if you position yourself right, you will have the biggest smile on your face while everyone is worried.
That brings the calmness back to you. So before we have to step away, I'm just curious, is there something that we can do that's, I'm going to say, not surefire, but maybe concrete that we can do this week, next few days? Given everything that we see in the news, we see a lot going on. We mentioned on an earlier episode, we talked about SpaceX and going to Mars, 1 million people on the planet. What should we ignore? What should we stay close to? What's one concrete thing that we can do that'll give us some solace?
Yeah, the biggest thing you can do is have a plan, right? Have a plan, and that plan needs to be, where am I today? What's going to happen in the future, right? What happens if everything goes well? What happens if everything goes poorly, right? Will I be protected? How aggressively do I need to grow my money, or how conservative? I highly recommend getting our bucketing strategy or a time diversification strategy in place, because that is going to give you that safety net. And you want to get as many safety nets as possible in place so that no matter what life throws your way, you are protected, right? You have a plan in place. And until you have that plan in place, I can lie to you and tell you, yeah, go do X, Y, and Z and feel comfortable, right? But it's going to last for maybe a few days, maybe a few months, but then the anxiety is going to come back, right? Because you didn't really solve the problem. You know that there's still something wrong. And so you need to really do the hard work and solve those things. And that's what we do for people, right? We help them think through it. We've got our free, it's kind of a try before you buy, that retirement tax SWOT analysis. Take us up on it, right? We'll create for you a financial plan that most advisors charge, a few $1,000s for. We do it. That's our pleasure, right? Where we'll do that for you, tell you, give you an action plan. This is what you should do for a second, third. And then it's up to you of whether you want to implement that or not, how you want to implement that. But that's really your first step, right? You need to know where you are and what it takes to have a sound financial future. And then you can decide, well, you know what? Of all the things that Leibel told me, that, the Yields for You team told me, this one or two things are the things that I really need to focus on. And compounding growth, right?
So before we step away, some quick questions for you. Should we rebalance or just wait till the market bounces back on its own?
You need to have a plan. That's the answer to that question. Yes, because if you don't have a plan, then I can't give you the answer to whether you should rebalance or wait for it to rebound, because that is very much dependent on what your plan is. For some of my clients, we rebalance aggressively. For others of them, we hold true and we just wait it out, right? Because that's what their plan says to do. So it really depends on what your plan is.
Call the advisor or just feed into the panic?
Always call the advisor. Come on, we got a couch for a reason.
How about accelerating that Roth conversion, or wait and see what just happens in the marketplace?
You always want to accelerate tax losses, right? You want to save money on taxes, right? Take advantage of these opportunities, assuming you can afford it, right? Because if it's going to put your financial security at risk to do Roth conversions, then don't do it. And I think we got time for one more.
What if I listened to you and I built my bucket, but I didn't react to the news at all?
Go you. That's exactly what you want.
That's all the time we got. And, the headlines will try to tempt you, but What we've learned here is that the retiree who stays calm is one whose money is already built to handle surprises. A bucket for near-term spending means this: a bad week never forces a bad sale, and a down market becomes a chance to move money into a tax-free bucket at a discount. You don't need to predict the future. We've learned that from Leibel. You need a structure, you need a plan, and you need the patience to see it work.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.